He's making his investments talk. Business Standard.
Mutual fund investments are subject to market risks.
He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
He's making his investments talk. Business Standard. He's making plans. He's making his investments talk. Business Standard.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
He's making his investments talk. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard. He's making his investments talk. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
He's making his investments talk.
Hello everyone. Leading economists, fintech and small finance bank heads have helped us decode the new normal for the BFSI sector so far. And today, in the fourth session of Unlock BFSI 2.2 with Business Standard, we have CIOs and CEOs from leading mutual funds with us. Also, a couple of very busy days in the series ahead. We have 2 sessions on insurance on August 26th and 4 sessions on banking on August 27th, including a keynote address by the RBI governor. Do take a look at the schedule on bs-bfsi.com. Happy to take a few questions for the panelists after the initial discussion. Please send them in the questions box on the website or as comments on Facebook if you're watching the Facebook Live. For social media conversations, use the hashtag BS_BFSI. May I now request Mr. Tamal Bandyopadhyay, our consulting editor, to start the discussion.
Thank you, Manish, and hello and very warm welcome to all of you, including the audience. Good evening, good morning, good afternoon, depending on which geography you are in. I believe there are people also from overseas have joined us to listen and to see India's 6 finest brains, brightest minds in the mutual fund space. So who are they? Aditya Birla's, Bala Subramaniam, Nippon Microfinance, Sandeep Sikka, State Bank Mutual Funds, the largest one, Navneet Munat, Kotak's, Nilesh Shah, ICICI Screws, is Naren, and last but not the least, HDFC Mutual Funds, Prashant Jain. Welcome all. I'm just giving you names at random. There is no importance attached to it. It's a very interesting discussion. Is market going ahead of economy? In fact, I'm sure all of you have heard RBI Governor Shaktikant Das today on a TV channel. In his interview also, he had said that it's a liquidity-driven rally. Yes, market is ahead of the economy. How much Indian stock markets have rallied from its lowest in recent low in March? It's 50% plus, purely driven by liquidity. And since there is nothing much is happening on the exchange rate front, so even in dollar term, the return for the investors, overseas investors, is 50% plus 51% or so, both Nifty and Sensex. Globally, what is the scenario? I think there's only one market which has done better than India, that is Russia. I think around 54%, but US close to India, but less than India. Japan, Indonesia, China, Hong Kong is far, far lower. So it's the second best performing market since March. And another indication is that the India Volatility Index, the VIX, which is a sort of barometer for the anxiety and fear which the investors have, it's receding. I'm not saying it's at the lowest, but which was very high. That's considerably coming down, which means investors are not scared of the market anymore. And I'll just end by saying 3 pointers. Where is the valuation? Now, you are the experts, and please excuse me if I am gone anything wrong. I think overall, if we see the price to book, which is marginally below the long-term average at this point of time, price earning significantly higher than the long-term average, and market cap to GDP again is marginally higher. Of course, the other factor in the third thing, the market cap to GDP, because our economy is shrinking. So not only how the market is performing, because economy is not performing to that extent, market cap to GDP has been determined, but that's marginally higher. And one significant aspect, I'm not getting into the micro detail that how the small caps are doing and mid caps are doing and all. But one significant change in Indian market, what we are saying, and not only India, probably globally, is now, people are not chasing more than the value, people are chasing growth stories. That's the kind of scenario. With that, the rules of the game are very simple. I have no opinion. People have come to hear you, so I'm not going to interrupt you. But let's make it short, brief, and as many rounds as we can have. And my job is primarily to give a line here and there to listen to you. And some of the rounds would be for everybody, and a few rounds will be specific. And at the end, we'll take a few questions. So let's take out the first round. Do you agree that the market is going ahead of the economy, and how long it will last? There are two views. One view is this: it will continue to last. So it's not that don't be afraid. And the market dynamics, the volatility indicators, etc., saying that. But there are other experts who are warning that no, it can be derailed because inflation is raising its head. Reserve Bank of India is not going to be liberal on the rate cut, fiscal deficit, so on and so forth. Even though Governor Das is always reassuring, he is determined to maintain financial sector stability. And he said, I have all arsenals, even new weapons on my table. I will use anything to tackle the situation. It's very, very reassuring. But is it justified, the market? I think let's random. Nilesh, on my screen, you are in the center. So let's start with Nilesh.
Thank you, Tamalda. I think market is factoring in certain scenario. If that scenario develops out, then probably it will not be wise to say market is ahead of the market, ahead of the fundamentals. And if that scenario doesn't develop, then certainly it will be fair to say market is ahead of its fundamental. At 11,371 Nifty, what is market pricing in? One market is pricing in that there will be resumption of normal economic activities as medical solution is round the corner and economic activity level is picking up. Now, if medical solution is delayed, there are more lockdowns, then certainly market will prove to be ahead of fundamentals. But if medical solution arrives on time, economic activity resumes, then it will not be fair to say market is ahead of its fundamental. Second thing, market is factoring at this point of time that the economic package announced by government which includes monetary stimulus by RBI, will work on the ground. Now, if there is desired effect of that 20 lakh crore package, certainly economy will recover and market will not be ahead of fundamentals. But for variety of reason, if that does not get executed on ground, it remains on paper, then certainly growth will disappoint and market will be ahead of its fundamental. The third thing which is factored in by the market is participation by institutional and retail investors. The fund flow from mutual funds, from insurance companies, from FPIs, from retail investors has been fairly heavy. And despite large issuances, especially from banking system, the supply has been absorbed. Now, if this fund flow assumption goes wrong for a variety of reasons, then certainly market will be ahead of fundamental. But if the fund flow continues to remain strong and absorb supply, then certainly market will not be ahead of its fundamental. So I can keep on going narrating many factors which market is discounting today. I will just end by saying that if the future scenario develops as per the expectation of the market, then market is not ahead of its fundamental. If future scenario is better than market's expectation, then market will rise. If future scenario is worse than market expectation, then markets will certainly fall.
Thanks, Nilesh. I mean, you have simplified, but you didn't answer exactly because you sounded a bit diplomatic. We explained the entire scenario, but the ifs and buts continue to remain. So let's hear Naren, if Naren takes it forward.
So actually, it's I look at it slightly differently. Actually, there's a pool of savings with the people. Now that pool of savings keeps going up, and that pool of savings is now increasing because people are sitting at home and they don't get a chance to spend. They can't go to a mall, they can't go on a holiday, they can't travel outside. They're just sitting at home consuming only essentials. So you decide what do you do with that pool of savings. What all the central bankers in the world have done is brought the interest rates down to zero in the other countries, brought it down to very low in India. So the pool of savers are saying, what is this 3.5% repo rate? What is this 5% fixed deposit rate? So they're saying, well, then can you invest in real estate? It has not given any returns for the last 7 years. So that pool of savings, people don't want to invest in other asset classes. So people say, let's go into this Robin Hood in US and in direct equities in India. And in direct equities in India, they got the chance to start in April. And in April, they started getting 1 year's FD interest in 1 week. And that's how it has started. So they have got more and more enthused. And, people don't understand risk. So in 2017, when we used to tell people that the higher yield to maturity in a credit fund means higher risk, people used to say, what are you saying? There is nothing called higher risk in a higher yield to maturity. In 2017, we used to tell people that small caps means higher risk, even if it gives you a higher return. They used to say small caps means higher returns and lower risk. So today people say direct equity is much safer than anything because you get one year's FD return in 1 week. So this is what has started, and only when the risk plays off do people understand risk. Till that point of time, higher yield to maturity means lower risk. So today, 1 week's return, you look at what is happening after April, every week people are getting 1 year's fixed deposit return in stocks. So that is what is happening, not just in India, it's happening across the world. Across the world, interest rate is zero. So even if they get 0.5% return, it is equal to 10 years fixed deposit interest. So that cycle has started, and that cycle till one day that shock happens, and we don't know when the shock will happen. Like in credit, one day the shock happened. One day the shock happened that small cap stocks fell. We will not know when the shock will happen. Till that point of time, this cycle lasts. And that is the challenge at this point of time, that people don't have alternate savings venues. And there is no one to educate people that there is a risk in direct equities, that all the returns that you're making in direct equities has its own risk. I've been a stockbroker from 94 to 2004 before my fund manager career. And in that period, I've seen people lose money in 95, 96, and 2001 too. But those periods, investors are not there. So if you meet many of the stockbrokers of this generation, they'll tell you all the investors are 25 to 30-year-olds. They have not seen 95, 96. They have not seen 2001 too. So how are you going to tell them that you can lose money in direct equities? And a lot of people lost money in 95, 96 and 2001 too. So that is a challenge. And that is why I think, we have to have movements which explain that there is a risk in direct equities, that there is something called equity risk premium. It is not equity risk discount. That if there is 3.5% in fixed deposit, that is certain. If you're getting something in a liquid fund, that is more or less certain. And these kind of things are the challenges at this point of time. That is why the asset classes which are doing well, like gold and equities, they are the asset classes where all the savings is going. Today we have a situation, there's only one borrower and everyone else is a saver. That is the challenge at this point of time.
Yeah. Thanks, Naren. While Nilesh explained the academic part of it, basically demand-supply theory and what's going to happen, and market always factors in the futures, Naren has given a ground reality sort of, what you said, you did not use the word is irrational exuberance. That's what you said, that there's a lot of money now with people and they have nothing much to invest in. Real estate is not giving return. Bank deposits are at the historic low. State Bank of India savings bank is 2.75, UCO Bank is 2.5 interest rate, and others FDs are around 5%. So this is the time, whatever money you have, and because there is no discretionary spending, we are saving more, even though many of us have been affected on our income front. But still, whatever money is being saved, you are saying it's better. 1 week's return is better than a year's return. So that's but we need to tell them what exactly the scenario, and the thing is meant for that. Today's event is meant for that, to tell the investors what they should do and should not do. It's not a classroom, but looking at the macro and giving some kind of guidance, not where to put your money, but how to behave. And you rightly pointed out what is happening. So let's hear, Bala, your preliminary takes.
Thanks, Tamal. See, first and foremost, Tamal, I would give the credit to the policymakers. The reason is when a similar situation occurred in the world post financial market crisis in 2008, with the policymakers took almost about 1 to 1.5 years to take steps at each time after discussion, understands how each economy is going to get impacted, and then they start reacting, whether it is bringing the interest rates or increasing the fiscal stimulus and so on and so forth. This is the first time ever, after many number of years, the policymakers reacted very quickly, especially US post, I think, March. I think the way the speed at which they reacted, it's something is unprecedented. And none of us, being in the financial market, would have estimated the kind of support which has been given by, whether it is the US in the form of cutting down bringing the high liquidity, increasing the money supply growth, and providing benefit to the large pool of consumers or maybe the savers, giving money directly in the hands of people. This is the first time I think we are talking about the support as a percentage of the GDP. I think it has gone as is about 14% of the GDP has now been given the support, both in the form of fiscal stimulus as well as the monetary stimulus. And if you also draw a parallel to India, the very fact that Prime Minister of India spoke about 20 lakh crore support as being given due to the COVID. This is not a small amount, whatever you may think. It's a very big amount, and it has led to a significant drop. One, of course, the interest rate, absolutely no doubt. Even the companies who are actually thinking that how I'm going to manage my liquidity, initially people are a bit worried about that companies are going to have a significant impact on the liquidity. They're not going to have much access to the money. and the interest rate is going to remain high, and completely got reversed after a month or about 1.5 months. Therefore, the full credit for making this kind of scenario goes to Reserve Bank of India in India and most central bankers globally, and of course the Ministry of the respective ministries across the global market have actually created this kind of environment. The moment this environment gets created, then naturally from a saver's point of view, as Naren mentioned or Nilesh mentioned, naturally actually the low interest rates starts making people think about what are the alternates in which I can go for it. Then the risk on trade comes in. Then naturally equity has been found as something as I'm carrying a risk to buy a 10-year bond in US. So I get about say 0.5%. Then I carry the risk. Even if the 0.5 goes to 0.7, I carry the risk. If I invest in equity, if it goes up or goes down, I'm carrying the same risk. Then which risk actually the better to take during this period? I mean, that's why I think the money has come into the equity. And that's something is a fact. And that's why people have shifted the money. Second, of course, the gold as an asset class also where money got shifted. Purely in the base of real rate of interest in the US has become so negative, and actually you have to hedge yourself in some other securities, which can give you a real interest rate. So that's why I think money has moved in. I think India point of view, we are simply followed the trend that has existed in the US market, or maybe the global trend that we have simply followed. I think everybody talked about direct equity has come. This phenomenon is not just come only in equity in India. This is a global phenomenon. First time aware, the lockdown period, people are sitting at home. Maybe the education levels would have gone up. And therefore, the larger participation come into the risky asset class. Basically, the risk on has come back. That's why I think the money has come into the equity market. But having said that, market always runs ahead of the real time. And this is the first time aware. I think if you look at most of the analyst reports, 2020 is considered to be as a normal, is given, and given the fact that COVID is impacting not just India, it's impacting the whole world. Therefore, 2020 is something needs to be taken as a year to be given up. So that being the case, nobody actually is looking at 2020's earnings growth. Everybody's looking at 21-22 earnings growth. I think the kind of support that has come from the regulators, it also holds the potential of creating a V-shaped recovery in the year 2021. I think that's creating high possibility for that. Therefore, if we expect to say another 6 months or 8 months, things to come back to normal, and therefore it can lead to a V-shaped recovery, then can I actually participate in the equity market just before that? I think there's a high probability that there's a probability of missing it out. Therefore, the larger participation will come in a short period of time. And that's why I think my opinion is the equity market has given a big push. And as always happens in the market, the earnings always follows. First the momentum comes, first the participation comes, then the earnings comes, and so on. That's the way I think cycle moves in. And even during this COVID period, Tamal, I think the last 1.5 months, fortunately, the government of India have kept changing their rules of the game continuously in order to ensure the economy doesn't get unnecessarily get derailed. We don't see too much of issues coming in and hitting and putting a brake on the economic growth as and when it has to pick up. Therefore, they also done a lot of course correction on a continuous basis, which also, in my view, has ensured the sentiment remains intact. There used to be a time when, in our own case, we used to go and make so much of representation. At some point of time, we all used to get frustrated as a market player why the regulator is not able to listen. The moment they start listening, probably they are more concerned about some of these things that should not happen in the market. Therefore, they have become more proactive. So that's something which I think we have never witnessed. In my view, is that multiple combination has led to this market rise.
Thanks, Bala. So we are getting very different views where Nilesh is essentially academically dissected the scenario, why it is happening and how it can be corrected or can continue. Naren says it's basic. He did not say this, but I'm putting words in his mouth. But he meant it is an irrational exuberance, what we are saying. Whereas Bala is, you are probably justifying what he's saying. He is saying that the market has got a sense that economy is on a right track, and because of the government and Reserve Bank of India, economy will improve, and that's what market has factored in. So basically, you don't see any irrational exuberance. You are justifying what the market is doing. Let's hear Prashant.
Yeah, thanks, Kamal, and good morning, good afternoon, good evening, as the case may be, to all the viewers and listeners. I think first we need to appreciate a few things. The last 10-year returns of the markets are in single digits. And even going into the COVID, market returns were trailing nominal GDP growth for a very long time. And all that the markets have done is that they have recovered the losses of post-COVID periods. Second, we need to appreciate that interest rates have fallen. And lower interest rates, they increase the fair value of equities. And that's a well-known fact. Third, the impact of COVID on the economy. I mean, yes, current year the economy will degrow. But what is the value of 1 year's loss of profits to the DCF of a business? Maybe 5%. So let's say assume a business makes no profits in the current year. It impacts 5% value, not more than that, probably less than that. So that is the third point we need to appreciate. Fourth, markets are forward looking. And I think markets are already beginning to look at next year and possibly the year after next. So I would say these I don't find any irrational exuberance in these markets. And right through this time, I have done multiple such webinars, and our view has been very consistent that let the drop in earnings, which is a very temporary thing for 1 year, let it not create a fear about equities. And in fact, this fall should be used as an opportunity because the intrinsic value of the businesses is minimally impacted. And I think the fifth point, very important, what many commentators probably are aware but they miss, is the very is the fundamentally different composition of the economy and of the stock markets. India is 2/3 a consumption economy and 2/3 a services economy. But look at the composition of Nifty. The weightage of consumption is barely 20%. Reliance, oil and gas, metals, software, pharmaceuticals, these businesses have less to do with the economic pain. This current economic situation will cause a lot of pain to the low and mid-income groups in the country. But the corporate profitability, I think, will do reasonably well, except in 1 or 2 sectors. In fact, if you look at the results of first quarter, most results are ahead of expectations because the cost savings have been much beyond the or significantly beyond our expectations. So I think, and most companies are telling us that the current experience has shown them how to cut costs. So I don't think these markets are getting it wrong. And even today, if you look at the market cap to GDP of India, price to book value multiples, it is quite reasonable even after this rally. And you mentioned P's are high. So I agree with that. But why are P's high? See, one, it does not make any sense to look at P multiples for current year because current year is not a normal year. P multiples lose their utility in a year when either the profits are temporarily high or they are temporarily low. So either you look at price to book or market cap to GDP, or you look at earnings for next year. And the moment you do that and consider the current low level of interest rates, I think you will find there is reasonable value in these markets. And whatever, to my mind, barring 1 or 2 sectors which are trading significantly ahead of long-term averages in terms of P multiples. See, the averages hide a lot. And even in this market, these are very polarized markets. Certain sectors are at lifetime low valuations and 1 or 2 are at lifetime high. And you can also assess that from the fact that the rally over last 2 years has been extremely polarized. 18 and 19, just 5 stocks delivered 100 or more % of the Nifty returns. Even in this market, if you look at Nifty, while Nifty has recovered, many stocks are significantly below where they were. So I would say these are markets that are expensive in few pockets, They are fairly valued in some pockets, and they are offering good to deep value in some other pockets. And so I don't think, to summarize, I would not worry about the markets too much, and I would not be in the camp which would say that the markets are running ahead of the economy.
Thanks, Prashant. It's a classic divided house, and that's good for our audience. Where Nilesh, as I said, is very neutral. Naren, in one extreme, that irrational exuberance. Bala is justifying what he's saying, and you are exactly the opposite. Naren is saying no, is absolutely everything is fine. Market is not ahead of economy. You are justifying what's happening in the market. You think it's justified. So we have two more gentlemen left, Sandeep and Navneet. Sandeep, your turn.
Thanks, Tamal. So let me, because you earlier mentioned people are taking a middle path. Let me start by this stand. I don't think so. Markets are overvalued.
Mm-hmm.
I think when we look at the period, markets have come up 50%. Almost all the gains, from the lows of March. But I think the way you have to see is markets are never rational. I think there's sentiments. There are many times there's exuberance, there's pessimism, but effectively markets will reflect the fundamentals. While we all look at what happened during COVID period, I think one needs to look back. Even if you were to look at back the 5 years, the Indian economy has grown from a $2 trillion to $2.75 trillion, which is roughly grown at about 5%, about 5%, nominal growth of 11%. But if you look at the Nifty, it has only grown 5%, which Prashant also mentioned in a single digit. And also, if you were to look at beyond Nifty, I think it's a very different story. The top 150 TRI absolute return is minus 18%. 250, it's minus 38%. And also many times what we see is, stock market is not a reflection of entire India. There are a lot of unorganized sectors. There's a lot of things happening in the economy. And I think we clearly see things are far better in unorganized sector in smaller cities and towns. And the recovery in the post-COVID is also starting from smaller cities and towns. So I think I would say, I think clearly looking at the way things are happening, this year could be a washout, which it's already captured in the price. But from our point of view, we do not feel the markets are overvalued. And clearly, one thing that we see in any economy, when the interest rates are coming down, the inflation is coming down, people will start moving away from hard assets, from gold, real estate, into financial assets. And this is the time. I think we really believe what has happened in the last 3 to 4 months. You have seen more investors coming into the capital markets. Does not matter whether they come in through direct stocks. The fact is today the base of capital market is getting broadened. So I think we clearly believe, I think if we leave us out, this is an abnormal year. I think we should not give too much weightage to this year, but fundamentals of the country, economy remain positive. Many times the economic data which comes is of past, but markets are forward looking. So I think the way we need to see this is, I think we do not get carried away by the fact that markets have come up from the lows of March. If we leave aside the next year earnings, I think we still remain, there's enough returns to be made for the investors.
Thanks, Sandeep. I think, Naren, you are a minority.
No, I think you should give me a minute to explain what I was trying to say.
I will. But let's hear Navneet last one. But I'm even sitting, with you, I'm also pretty surprised with the kind of optimism that you were exuding, because still 5 o'clock before we started, I was also a believer till I heard that market is ahead of the economy. And we heard RBI governor this morning also saying that market is ahead of economy because it's liquidity driven. So Navneet, of course, Naren, you get your chance, all of you, second, third term. But Navneet, first your preliminary remarks.
So markets are supposed to be forward-looking. There is no correlation between quarter-on-quarter GDP growth or year-on-year GDP growth and the stock market returns, because the economic data is a lag indicator while the market is a lead indicator. Now, I think, Tamal, you are trying to say that it is a divided house, but it is like one elephant and 6 people are looking at it and only touching one part of it. I think all of us will be proved to be right. Is this the mania of the mob, which like Naren kind of alluded to, that there is maybe some bit of irrational exuberance known as Robin Hood effect in the world. I think there are some traces of it. When you look at one single auto company which has less than 0.5% market share of the automobile industry, but has more than 20% market cap of all the auto companies. Or I can go on. One single company in US is much bigger than the entire German market or the entire floating stock of Indian market, or more valued than 2,000 companies in Russell 2000. And the same thing in India. So there are parts of market where you can clearly say that it seems to be a mania of the mob. There is also a wisdom of the crowd, which I think Nilesh Bhai and Bala and Prashant, everybody talked about, that there is optimism about a resolution to this crisis. Bala mentioned about the extraordinary policy stimulus that we have got. So if the crisis is unprecedented, the policy response is unprecedented to say the least. And if US money supply is growing at 24% YOY, which is the highest in history, and they've taken that to GDP to the highest since World War II, obviously that additional money is finding its way into the asset markets. And that's the reason bonds, equities, and gold are moving in tandem. And they are not supposed to move in tandem, because some of them are supposed to move in an inverse relationship, but they're moving in tandem, which clearly shows that excess liquidity is finding its way into all asset markets. Nilesh also talked about that market is definitely betting on an economic recovery. People talk about whether it's going to be V-shaped, that Bala mentioned, or maybe a U-shaped, or some people in March were talking about L-shaped. You have heard about W-shaped. I would say this is going to be K-shaped, and that's very important for stock market investors. There are parts and segments of the economy which will go up and they will do well. There are parts and segments of economy which will have either a cyclical big challenge or will have a permanent challenge in their business. The economy is not listed in the stock market. Thousands of subsidiaries of the economy are listed in the stock market. You look at those parts of the businesses which will do well. Prashant talked about like technology or healthcare, or maybe the rural economy, maybe the electronics, maybe chemicals who are beneficiary of the supply chain shift, Atmanirbhar Bharat. It could be some of the other companies where the near-term uncertainty will impact their business. But this situation will also lead to a creative destruction where large part of the business won't be able, large number of lot of businesses won't be able to survive. Then the survivors will end up doing very well, who have the resilience and who will invest right. So I think rather than trying to paint one picture that GDP is in recession and that's why market should go down, is not the right way to look at it. We have to look beyond maybe next 1 or 2 years. What is the potential in our economy and what is the potential for some of the sectors, and within that, some of the businesses who are preparing themselves to take advantage of the opportunity on the other side of this crisis. And I think that's the way to approach this market.
Okay, thanks, Navneet. So we heard about V-shaped, W-shaped, and U-shaped. Mr. Kamath, I heard V-shaped, but bottom is little flattened. So between V and W, and V and U, and you are saying about K-shaped. So that's good. Naren, you wanted to say something, just 1 minute. And we have many questions, but before that, we also need to have a few more rounds, but this will be far shorter rounds. But before the Naren, you wanted to add certain things. Naren.
See, basically what I wanted to say is, if you have very extraordinary low interest rates in the world and you have taken cost of debt to zero, what happens is, or in India, 3% or 3.5% interest rate is something none of us have seen in our lives. That causes a certain, it has nothing to do with equity valuations. It is actually debt interest rates being very low affects equity valuations, and that has affected everywhere in the world, including in US. So instead of the irrational exuberance phase that you used is the wrong word, in my opinion. I would say that it is more that if you have very low interest rates, it causes, you're finally operating in a world where you have two asset classes, equity and debt, and both are linked to each other. That's what I was trying to say in short.
Okay, so for the viewer and the audience, irrational exuberance was the term used by me. Naren is correcting me. It's exuberance, not irrational, right?
Yeah.
That's what? Is it correct?
Yeah.
Okay, fine. Navneet, you wanted to add a little bit.
So I'm just saying, I'm giving one example where, painting something with one brush, how it can lead to a challenge. So everybody thinks that consumer economy is going to be in big trouble. Of course, in the immediate near future, there is a demand destruction. People cannot move out. But think about it. There are millions of people who have lost their job or who are going to see an income erosion. They may not be able to spend the way they would have spent otherwise in the next festive season. But think about it, there are 3 crore people working in central government, state government, PSUs, government contractors, a lot of private sector businesses who are doing reasonably well. Those people have reduced their spending over the last few months, but their income is same. This is an effect very similar to, I would call it an 8-pay commission. Your income is same, but expenditure has gone down. You have that incremental money. Either you are going to invest in a mutual fund or you are going to spend that money somewhere. So I think there are various parts of the consumption economy also, and I'm sure we can talk about a lot of other parts of the economy in a similar fashion.
Okay,
There are going to be
thanks.
very interesting dynamics.
Thanks, Navneet. So now so whatever you said is actually music to the ears of our audience what they hear, because everybody is talking about imminent correction, market is going down, there is no reason why it should go up and all. But all of you sort of, including Naren in his second brief round, you said no, there is logic behind what's happening in the market. So now we'll cut into short issues, general thing we have discovered. So, and it's primarily the mutual fund related thing. I mean, August we find that the equity funds have seen big outflows. This month I'm talking about. So investors appear to have cashed out on equity markets because they see, you do not see, but they see that big market crash coming and they wanted to book profits. So is it right way of seeing this, or why is this happening? Prashant, you want to say?
See, what I have experienced is that whenever there is a very sharp fall in the markets for whatever reasons, and mostly such very sharp falls are due to some events like 9/11 or Lehman. So this value erosion comes as a shock to people, and whenever there is a recovery, people feel relieved and they want to cut their risks.
Okay.
And because they have seen very low values, so emotionally, a section of the investors finds it, comforting to take money off the table because those memories of low values are still with them. So I think, and I was in a way expecting this, and we have seen it even in the past. After a sharp fall, if the recovery is fast, you will find some redemptions. But we must never lose sight of the denominator. And so look at the total AUM of equities. And when you put that redemption in the context of that AUM, you will find it is maybe 1% or 0.5% or 2%. And I think if markets stabilize at whatever level, whenever they stabilize for 1-2 months, I would suspect that the redemption should move lower. In fact, just one last point here. See, just think 3 months ahead or 6 months ahead. Assume a day comes when lockdown is over and the headlines move back to normal. Then people will, as Naren said, and as few others alluded to, you will see interest rates of 3% and 4% and 2% after tax. I think in that environment, the flows into equities will actually go up very sharp.
Okay.
Because the risk perception is normalized. And you are right now there is a flight to safety. You say, I don't care, I earn 2%, 3%, it's fine. Because the priorities are different. But the moment you come to a normal environment, the priorities, the focus will once again come back to getting a reasonable return on your capital. Yes.
Thanks, Prashant. Sandeep, you wanted to add?
Yeah. No, just to this question, I think the way you have to see.
We have seen outflows in August. Yeah. There is, I will not call it massive. So basically, they are taking money, bringing cash on their table. So as a mutual fund from the industry, how do you read this? That's what the question.
So I think you have to peel the onion. I mean, when you look at this data, I think it's more to do with the type of investors who are withdrawing the funds. When you see this, it's typically the industry is divided, and you have sophisticated investors, you have HNIs who will always take advantage of timing of the market also. The fact that the whole debate that we started, markets have run up so much from the low. These are those set of investors who will, some of them will, based on what has happened, will react to the market. But what I draw comfort from the fact is, when I look at all the redemptions, the 10,000 and the 50,000 rupee investor, he is not withdrawing. And these are the investors, which is the foundation of the industry. So I think, and we will have to always understand the fact there will be investors who will come for short-term, time the market, see the environment and react. And there will be investors who are very stable. So for me, the comfort comes from the fact, even today, you continue seeing new incremental SIPs coming. Someone can look at the number and say that I think we've seen a little slowdown in that. But this is not the first time. It will always happen. These are the situations, these are extreme situations. People are looking at taking care of their health, various things. It's not that everybody is going out and investing. But the comfort comes from the fact the foundation is strong and the small retail investor is still not withdrawing.
Okay,
Just
thanks,
add to
Sandeep.
that, Tamal.
Yes, please.
Just
Bala.
to add to what Prashant and Sandeep mentioned, I think the fact that the industry is, since 2014, industry had one of the highest growth both in assets under management, in equity and fixed income, and second is in the case of SIP's book size kept growing. I mean, the rate of growth were in excess of roughly about 25%. And the number of customers which are being added, it used to as about 20 lakh customers are being added to the industry. And that was the trend that we have witnessed. So I think, especially post demand, the asset growth in industry was so high as an alternate to a fixed deposit. That's why I think money started moving into the equity. And what you are seeing currently, the outflow, this again is a function of your past return suddenly not being up to your satisfaction, and therefore you move out temporarily. And these are some of the things which we have seen historically. There's a kind of trend emerges. But again, if you look at the total outflow in relation to the size, is actually very, very small. Secondly, I think the point what Sandeep mentioned, interestingly, during this lockdown period, there are about 5.8 lakh new investors have been added to the mutual fund industry through the online platform as well. Through the online platform, or maybe the new investors comes in. And that's why we always seen historically, the people who have been with the fund, maybe as part of the reallocation of their portfolios, some bit of churn does happen. But normally it doesn't happen with the retail investors. Mostly these are done by HNIs and MHNIs. And at the same time, you also see people coming and participating. Maybe the rate of growth on new investors coming in would have been far higher but for the COVID. But still, during the COVID period, where complete shutdown, despite being there, close to about 5,70,000 customers being added in the whole industry is also something is to be noteworthy.
Thanks, Bala. Nilesh, you wanted to add something.
Dada, I wanted to highlight the behavioral aspect.
Please.
Today we are all living in a very connected world. The WhatsApp, the Twitters, the digital connect has brought a lot of noise to the investor community. Now, there are limitations of mutual fund distributors to reach out to their investor base because of lockdowns. And in that environment, a lot of people are depending upon, what is being forwarded to them or what they see and read in the digital channels. And this has created a kind of behavior where we are seeing more redemptions coming in direct plans rather than in regular plans, where an investor who took a call based on past performance is now feeling disheartened and redeeming, whereas on the other hand, someone who went to a good advisor, good distributor, did his financial planning and was made aware that there will be volatility in equity funds, they have probably sustained their SIPs, they have maintained their investment. So, in my opinion, some amount of increase in redemption is driven by lack of appropriate advice by mutual fund distributor to their set of customers. The direct customers are redeeming or are taking a much shorter term view compared to investors coming via mutual fund distributors.
Okay, thanks, Nilesh. Point well taken. We just completed half of our discussion in terms of time. Other half we'll do it just after a very short ad break. Manish, over to you.
He's making his investments talk. Business Standard.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome back to Business Standards Bfsi 2.0 discussion of mutual funds. Is market moving ahead of the economy? So we have completed the first half, and all our panelists more or less are on the same boat. Market is not moving ahead of the economy, and they're justifying the market behavior. Let's talk about one thing. I think one of you at least discussed that or hinted at that. I think Navneet or somebody. So whoever wants to just raise your hand, say that this is what we have never seen. The millions of millennials are getting into the market during this COVID period, and that's happening. I mean, it is what you call it Robin Hood in US, in India also. The number of, I'm not getting into those numbers, the numbers that have risen, people getting directly into the market. No, one of you could be, yes, there is more disposable income because discretionary spending has gone down despite income is down. Other way of looking at it, nothing else to do, sitting at home. Yet other way of looking at it, many of them have lost their jobs, no money. So whatever little money they can make. So I know there are many young people who have never been to the market. They don't understand market, but they are in the market. So how do you describe this phenomenon? And is there any way to bring them back and educate them to the mutual fund route? Because they're all going directly to the market. Who wants to say this? Who wants to take up? Naren, Navneet, whoever you want. Sandeep, you want? Okay, you raise your hand first, and then Prashant can give. Yeah.
No, I think I mentioned earlier also, I think we should see the base of capital market, if it gets enhanced, it's a very positive thing. We have seen the growth of the mutual fund industry. There's always been a lead or a lag effect of when every time we've seen there earlier used to be a lot of IPOs, new investors came during the IPOs, and eventually a lot of these also helped these investors finally came into the mutual fund industry. Last couple of months, 4 months, we have seen the highest number of DMATs opening.
Yes.
Many times this question comes, are people going to go direct? I don't think so. We need to get worried about that. As long as we are all a part of the same pie, whether investors go direct, somebody will go direct. Right now, there was too much time in hand. I think one thing I can say from the experience of this lockdown, anything which had to do with the screen time, people spent disproportionate efforts on that. So whether it was broking, whether it was Netflix and binge watching, or whether it was to do with anything, because there was a lot of spare time available. So I'm not worried about these investors going direct. This is the biggest positive that can happen because this is the new generation which is going to be having cash in hand later. They are going to be this, they're coming into the working population now. And it's good. A lot of people of our generation got into the equity culture very late. I mean, this generation is getting the taste of equity much earlier in life. So I actually take it as a very positive for capital markets of India, and anything to do with capital markets, whether it's to do with broking, whether to do with mutual funds or anything. So I take it as a very, very big positive.
Okay, thanks. Prashant, you wanted to say or Naren? Okay, Naren, tell us.
No.
I mean, is it a moment of truth for Indian market, the COVID moment? millions of demands are being opened every month, people are coming? Or is it just by default, people have nothing to do this out of desperation? Can I make some money? That's the approach.
I left investment banking in 1994 to become a stockbroker. So I've seen it between 94 and 2004. So what I hope that the millennial generation does it in a disciplined way. What we've seen is in the 94, 95 boom, people used to enter stocks like Femnor Mineral, Pandian Graphite, Balaji Distilleries, Balaji Steel. These are all companies which you would not have heard of. And in the 99 boom, people entered stocks like Global Tele, Penta Media Software, and DSQ Software, and all these things. What worries me is that as long as people are disciplined, they follow a process and invest through a process. Like recently, one of the good things, if you ask me, is that people have been investing in A group stocks and not using derivatives. I think and invest, that would be a very good thing. But what happens is vastly it kind of degenerates to investing in stocks without fundamentals based on tips which are there in all kinds of online journals and various other things. Then it goes out of hand, and then they lose money, and then they blame the stock market. The stock market is not a source of their losses. It is the process that they followed in the stock market which can be the source of their losses. So I agree with Sandeep that if they come into the market and stay in the market in a sensible way, it's good. But that is the challenge. And if you see many of the people who are entering are people who are in the millennial generation, who have not seen 2007, 8, 9 setback. They have not seen 99, 2000, 2001 setback. They have not seen 94, 96 setback. So, the problem is, like, I go to my guru, Dr. Atul Gawande, and say, you create a good checklist, get it vetted by a good person, and follow that checklist while investing. If you do that, it's very good. I think we'll have a very healthy culture. But if you start a checklist which is built on speculation, then you will make money in the bull market as long as it lasts. Then when the bull market ends, you lose all the money you made plus some more money. And then you blame the stock market, you will blame everyone around you, you will blame everything, and that will be the problem.
Naren, they will not blame you. They heard you. They are hearing you, those who are there. Anybody else want to add quickly? Then we'll get into this. If not, then tell me one structural thing, and I am seeing it that, there's a lot of inflow into ETF. ETF is something, I think, about 13,000 odd crore in July. We had seen the inflow, whereas from equity, we are seeing that getting out of it. So what does it mean? Is it a structural shift in the investor behavior from active fund to passive? That's what you are reading it. Do you see more and more people are getting into ETF? Is it what happening in Indian market? Anybody wants to? Yeah, Prashant. Yeah, yes.
So I think what you said is right, and the flows into ETFs have gone up. Of course, they are still very small in terms of the share of ETFs. I think what has happened is many active funds have not been able to beat the indices in recent past. And I think the reason for this is I alluded to earlier. If you look at the returns of the index last 2 years, just 5 stocks in the Nifty gave or created 100% or more in 1 year of the Nifty returns. And in an environment like this, when it's very, very top heavy, it becomes extremely difficult and challenging for anyone running with 20, 30, 50 stock portfolios to beat the indices. Go back 5 years and people used to laugh at the Nifty. And I've met many investors who would say Nifty is not competition for me. I beat it hands down. And that was a time when small mid caps were doing extremely well. So I think that was one extreme of the market. And what we have seen until very recently was the other extreme end of the market. I think the way I see it, we are now moving towards a market which is becoming increasingly broad-based, and you can see it in the movement of the Nifty and the various indices in the last few weeks and months. So I think active funds should be able to come back and add value over the indices. I think the second thing what we should also not lose sight of is that the last 10-year returns of Nifty have been in single digits. And if you look at the fund costs, they become pretty meaningful in the context of single digit Nifty returns. And when returns by themselves become a little more healthy, I think this hurdle posed by operating costs will become more reasonable in percentage terms. So I think over time, active funds will make a comeback and they will once again add value as they have done for many, many years. But yes, if you think 10, 20, 30 years, then I think index funds will grow. And please don't lose sight of the fact that the mutual funds in India own less than 10% of the markets, whereas in US that number is close to 40-50%.
Yes.
So I think this industry and equity ownership in India has a very long way to go.
Okay, thanks, Prashant. Anybody else? That ETF, that trend into passive, yeah, Sandeep, because that's the overseas, that's the trend more and more. I mean, if you see in percentage term, people getting into EPF is far, far higher. But now, do you think in India this trend is starting? Sandeep, you wanted to say?
Yeah. So, Kamal, the way I see it
and
is,
would you encourage them to do this?
Yeah, I think I clearly see, I think the trend for ETFs continue. When we look at US, the Indian asset management industry is exactly where US asset management industry was in mid-90s for $350 billion. And from there, in next 15 years, things change very fast. I think I do not want to put a number to it, whether it happens in 15 years, 20 years, or 30 years, because in US, the equity culture was always much higher than India. I think the way we will have to see is going forward, the trend for ETFs will become more popular. The fact that, as Prashant mentioned, especially the last 8 to 10 years, where I think especially the broader markets and also the Nifty returns have been, the active fund in large cap has been a single digit. We have seen a trend where especially the sophisticated investors have started moving more, especially in the large cap, towards ETF. And also there's the fact that the benefit for them, the lower cost compared to active, adds to the net return. So I think I would not take ETF very lightly. I would see a trend towards ETF will gain momentum. Will it replace what active? Never. I don't think so. It will happen in next maybe in 30, 40, 50 years. But I think it cannot be ignored. And as an asset management companies, for asset management companies like us, I think what we'll have to do is we are going to leave it to the investors to take that choice. I think we'll have to keep offering them all the options, active, passive, index, and I think let their advisors help them to take the final call whether they should come into active or index or ETF.
Thanks, Sandeep. So we'll have, okay, Navneet, yeah, please.
So I think that there is a lot of scope for growth for both the active and passive in India. A large number of investors in India are yet to meet the market, and you need to worry later about how to beat the market. So I think there will always be a potential if you want to beat the market and be with fund managers who have done it for a very long time. Some of them may not have been able to do it in the last few years. But you talked about the US. So I just tell you one number, why the ETFs have become so large and active managers are finding it tough to beat it. If you take the top 8 stocks in S&P 500, which is the most popular index in terms of the ETF AUM in the world, 8 stocks are up 35% YTD. Your typical Apple, Amazon, Alphabet, Facebook, Netflix, Microsoft. The remaining 490 stocks or 92 stocks are actually down 5%. If you bought anything other than these 8, you have not done well. And there has been a momentum that the ETF guys buy exactly what is the composition of the index. If you try to do anything else, you have not been able to do as good as S&P 500. So S&P 500 is beating every other strategy over the last several years. But I'm sure the sheer rise in the passive AUM itself will lead to opportunities for the active managers over a period of time. Prashant made that point that as the rally becomes more broad-based, we have seen a huge polarization in the market gains, and which is backed by a huge polarization of the profit pools also for few companies. Over a period of time, it should change and should give more opportunities to the active managers to do better than the index. And I think the rise of Robinhood effect will only lead to that source of alpha for the active managers if they get their act right.
Okay, thanks, Navneet. We have many questions, but before that, we need there are two questions for you in the two rounds. Not everybody has to answer. Nilesh, you are keeping quiet, so I would like you to answer this, and then somebody else can add. Is this basically, if I'm an investor, rather from on behalf of investment community, I'm saying that the SIP returns is pretty disappointing. Last 3, 4, 5 years, I'm not getting into the math of that. It's a pretty disappointing return, you know. Now, how long will they wait? They're running out of their patience. So, can you give a sense, Nilesh? I mean, what do we need to wait 50 years to see some return on that? Because you keep on saying, no, have dheeraj rakho, have patience, put in money in systematic plans, and you will make money. And I'm telling you with responsibility, going through the number 3, 4, 5 years, very disappointing.
Undoubtedly, Dada, the numbers on SIP return side are dismal. But are the SIPs generating alpha over benchmark index? In many cases, answer is yes. I'll just give you an example of my own emerging market equity fund for which there is ready data available. In January 20, when we looked at Kotak Emerging Equities 12-month SIP return, the number was 27%. 5-year SIP return was 11%. And 10-year SIP return was 17%. Every investor was happy with this number. Come March, 12-month SIP became minus 41%. 5-year SIP became minus 5%. And 10-year SIP came into single digit at 9. Obviously, investors who did SIP for 5 years or 1 year were extremely unhappy. In July, markets recovered a little bit. The 12-month SIP return is plus 6, 5-year is plus 4, and 10-year is plus 13. Now, obviously, still 5-year SIP returns are below fixed deposit return, and legitimately investors are unhappy. But this is the time to buy equities. In SIPs, you buy equity when things are cheap as well as when things are expensive. In every bear market, when you calculate SIP return, it will always look negative. But if you continue your SIP in that bear market and calculate when the bull market begins, SIP return numbers come into double digit. Between Jan to July, the numbers have moved from extremely satisfactory to least unsatisfactory to little below satisfactory. So this is the point of time where one needs to keep faith in SIP. If you have financial emergency, please stop your SIP. No problem about it. But if you have money and you are not doing SIP because SIP returns are negative or SIP returns are lower, this will be a mistake. This is time to add equity. And going forward, whenever market rises, the SIP which you have done at this point of time will deliver the maximum return.
Thanks, Nilesh. Bala, want to add?
Yeah. Tamal, I think interestingly, a similar question was being raised post the financial market crisis. The number of queries that were coming at that point of time, that should I put money in SIP, it's given a negative return. That question was there throughout the period of 11, 12, 13, for 3 years. 3 years, repeatedly the question is coming, should I continue my SIP, not continue my SIP, returns are low, because the past returns were low. Because we saw actually 2007 bull market, and after that we saw a little bit of bear market. The moment 2014-15, the market gave almost about 58% in a single year return. Single year, the market grew by about 58%. The second year it grew by about 28%. And subsequent years, the market actually got consolidated. In this period, somebody has not stayed invested, carrying the pain of seeing actually the past return being lower, and then hoping for the best to happen. Had he not stayed invested, then naturally you would have actually had a very bad experience of an SIP. But somebody has stayed invested throughout this period, irrespective of whatever the past return of SIP has been. The equity market behaves always 2 years of bull market, or maybe 2 or 3 years of bear market, maybe a fluctuating market. And this kind of cycle, if one doesn't go through in the case of SIPs, you don't realize actually the real purpose for which you are making investment SIP. Therefore, what Nilesh mentioned about one has to ride through the cycle. The past return at times may give you a different kind of feeling, but in a rising market, naturally SIP may give you a better experience, and a falling market it will naturally give you a relatively not so called good experience. But I think if you ride through, unless you ride through both the cycles, then it's something which I think will always end up having a doubt on SIP. But if you give a longer rope, then SIP and asset class does give a real benefit to the investor.
Bala, I'm repeating myself. How long is this longer? 5 years or 50 years?
Right. It has to be as long as possible. The Tamal, I think this question always comes. I think as an industry, we all give the same answers. That is as long as you take actually for any company to perform. Because there are many companies are being valued, keeping in mind some kind of terminal value, value that is being given for any companies to assess as the potential of companies in terms of valuations. If I apply the same principle in the case of SIP, as the longer the period we give is better for you. At the end of the day, no investments can be undertaken for the purpose of 1 year investment, 2 year investment. All the 1 year definition, 3 year definition, it's all coming from the income tax, only for the purpose of calculating tax.
So Bala, all you need to tell our audience is this: is it meant for someone's child or grandchild?
Exactly.
The benefit I'm asking. So from you, it's pretty clear that not in my lifetime. So should it be for my child or for my grandchild, the SIP return? Anyway, that's on a lighter note. Prashant wanted to add.
Tamal, I think in your question in itself, you gave the answer, and I hope people realize that whenever people experience subdued returns for equities for fairly long times, and when they start asking is 5 years or 10 years not long enough, that is probably one of the best times to be investing in equities. And if you look at the history of returns of Sensex in India, whenever 5-10 year returns have been significantly below long-term averages, what does that indicate? See, the rupee GDP growth rate in India has been by and large fairly constant. So when the long-term returns are below that, it indicates undervaluation. And as Bala said, equity returns are not linear. Your 5 years wait may get over in the 6th year. So in equities, I have always seen that the longer the markets don't perform, then the time for them to perform is probably shorter than what you think. And in equities, returns are never denied in my experience and judgment. They can be delayed. They will test your patience at times, like they are doing right now. But I think persistence in equities has always paid off thus far, and I see no reason why that should not happen now. One final point here, and I think that's an extremely pertinent point for all savers. See, while people complain about single-digit returns from equities over last 5-10 years, whatever, but please look at the opportunity cost of equities today. And that is what Naren referred to, and I think that is extremely important. 3-4% is what post-tax we will get in fixed income. And that is the dividend yield in many stocks. In fact, many stocks are offering you double-digit dividend yields, few stocks. So this is a unique market where several or many decent quality, good quality businesses are offering you dividend yields, which are much more than the bond yields. The same companies can borrow. If you lend to the same companies, you will lend at 6%. But if you buy their stocks, you will get dividends that are much higher. So I think whenever markets are undervalued, the trailing returns will look good. But I think that low trailing returns are showing promise for the future. So to my mind, investors should not lose hope, lose patience, and So, and there are
Thanks.
many years between 5 and 50. So if it is not,
Okay.
it would.
I'll add
Thanks,
one
thanks,
sentence.
Prashant. Yeah. Naren, yeah, you wanted to quick.
I'll add
and
only
then
one
we'll-
sentence.
Sure.
Our past data suggests that if you had actually you gave a very long answer, 50 years. But if once in 1994, 2007 and 2017, if you had taken out SIPs and put that money in, let's say, in a debt fund or balanced advantage kind of category, your accumulated SIPs, you would have had the best experience. So once in 15 years, you have a big bull market. In that big bull market, you should move your accumulated SIPs to a more defensive category. And that bull market happened in 94, 2007 and 2017. So
when
this
is
is
next? Naren, when
I
is
think
next?
it'll come in 2027 or 29 or something like that, maybe.
Okay. Okay. Now, last round. After that, there are many questions. And last round is slightly tricky, I would say. You may not like it, but just I want to understand one thing. Is that shadow of Templeton? No, the issue. Templeton I'm talking about. Is it that debt mutual fund issue? Is it now behind you? Because last year at every forum that was discussed, SEBI made a lot of changes in terms of debt funds. Now, are the debt funds safer, you think? Or do you think SEBI should have been a little more proactive at that point of time? And, instead of allowing them to delay for the investors' payment, actually, it could have been in a different way, instituting a probe and seeing that the investors are, get their money faster, etc. So if you don't want to talk about regulator, I'm sure you will not be comfortable. But generally, I want to understand how safe is the debt market from a mutual fund perspective, from an investor's perspective. Post Templeton, yeah. Niren, Naresh, Nilesh, Naren, yeah. Naren first, then Nilesh, and then anybody else.
See, my view is if you're going to have only a AAA debt market, then your growth rate as an economy will be much lower. I believe that as a country, we need money to go into AA certainly and over a period of time into single A also. And just like we have managed to create a small cap and mid cap equity market, we need to create a single A debt market also. Now, how the risks have to be explained to the investors, that is the challenge that the industry has. And like right now, we tell people that if you don't invest in AA, the actual returns that investors are going to get in debt funds is going to be very low. And that is why we believe that at this point of time, AA investing is absolutely necessary for investors. If you want 2% growth, if you want a very low growth in the country, I believe that it is okay to have just a AAA debt market, but we need higher growth. We need to feed more number of people. We need to create jobs. That is how I look at it. I'm earnestly hoping that the regulator recognizes that we need to create a AA and a single A debt market in this country, and explain the risks of a single A debt market to everyone. That's all I want to say.
Thanks, Nilesh. So, why not even junk bond market? Why only restrict to yourself AA?
I accept, but we could not. We first move to single A, then we'll think of junk.
Yeah, Nilesh first, and then Bala. Nilesh.
So one, I would like to assure all investors that mutual fund regulations are fairly sophisticated and at par with the best in the world. In Templeton, we are not looking at PMC kind of scenario where we suddenly discover that all the money were lent to one defaulter. The entire portfolio was available to you before the crisis and is available to you after the crisis. There may be liquidity issue, there may be partial credit issue, but it is not like a PMC bank where money will disappear. There will be reasonable amount of recovery to the investors, and whatever money will be recovered after paying necessary expenses will flow to the investors. This is the sophistication of mutual fund regulations, and which has stood the test of the time over the years. The other you will remember that in 2008 also, when crisis came for subprime, there was one mutual fund which had to stop redemptions in liquid fund.
Yes. Yes.
But rest of us continued our business as usual. In April 2020 also, Templeton had to apply for winding of 6 schemes. But rest of us, despite that unexpected shock, continued our business. Now, my submission to investors is that please look at debt mutual funds over last 20-25 years. In all this period, we just had to go 3 times for support to external world. In 2008, there was subprime crisis. Every single financial institution except LIC was at the mercy of Reserve Bank of India to provide liquidity. We also joined the same bandwagon with banks, with other insurance companies, with NBFCs to get liquidity support from RBI. 2013 taper tantrum happened. The crisis was far less severe compared to 2008. And all we needed was a mere announcement that we will be supporting mutual fund. And we didn't have to utilize one single naya paisa from that refinance line.
Sure.
In 2020, also because of this unexpected event, there was a need to restore investor confidence. RBI was kind enough to take action within 48 hours. And the utilization of that refinance facility is very, very small.
Yes.
So purely based on track record, where due to certain unexpected events, we had to take external support. But by and large, industry has continued providing service to the investors on an uninterrupted basis.
Okay. Thanks, Nilesh.
Dada, just one more point.
Please.
The second question which comes that, but what about all the defaults which you have incurred?
Yeah.
Undoubtedly, when defaults happen, there is a loss to the investor. But this is the price which one has to pay for generating additional return. There is no free lunch. You try to generate additional return, you have to take extra risk. And against the default, there has been as much amount of recovery also. So every default is not necessarily permanent loss of capital. Over a period of time, we have seen in segregated portfolio recovery of money. We have seen recovery of money in defaulter cases. So by and large, I would like to reassure investors that debt funds will have volatility undoubtedly. Some volatility comes because of movement in AAA rated bonds, PSUs bonds, government securities. In credit risk fund, some volatility comes because once in a while you have credit events.
Okay, thanks, Nilesh. I think you spoke on behalf of the industry body, which you are the chairman, right? Not as a Kotak person. So that's the macro view. Just now, I'm told the questions have crossed 100. So there are many questions I will take. But before that, Bala, just a small, 1 minute thing. Your interest is the Templeton episode behind the industry.
Yeah, I think as Nilesh and Naren mentioned, I think fixed income plays a very key role in the development of the bond market and financial market, even for providing a solution to the savers at large. In Templeton, it's one of an incident that happened because at that point of time between Jan, February, March, as Nilesh explained, liquidity was tight, the market got frozen, and everyone, of course, the rest of the people managed to raise the liquidity for meeting any kind of redemption that used to come in. But Templeton case had to happen because the time was completely different at that point of time. I think post April, May, June, if you see, I think the way things have improved in the bond market and the way the mutual funds have been meeting all the redemptions, this is something which made us all of believe that Templeton was one of case in the fixed income market that now behind us. Even from the overall, the experience from the investor's point of view, the mutual fund experience in the longer term has been so good. But whatever the loss would have occurred during the period of 2018, 19, which is an exceptional year, we have seen a significant downgrades and defaults that even if you have to adding all those things from mutual fund point of view, the component of proportion of the total assets which got hit because of the downgrade, etc., very, very small as overall percentage size. Therefore, one should not extrapolate that saying mutual fund fixed income is bad. I think it will remain one of the very strong vehicle for both the development of the market from the country point of view, providing resources to the needy borrowers going down from AAA to DA, and also generate return to the investors in the long run as part of the total asset allocation strategy.
Thanks, Bala. Thanks, Bala. So we have many questions. So what I'm planning to do, I'll just I'll give the question. I'm selecting because many of the things have already been discussed. So we'll pick up a few which is very critical and people want to know. So any of you just raise your hand and then answer the question. I'll just tell you to give the cue to the cameraman so that you are in the frame. First question is, as I said, what's your view on gold? Who wants to pick that up? View on gold? Yeah, Nilesh Shah, your view on gold.
So let me first talk about the risk factor of gold. In India, there is 12.5% import duty. If tomorrow there is a change in import duty up or down, to that extent, rupee gold prices will change compared to dollar gold prices. Subject to that risk, we are bullish on gold. Normally, when interest rates are low and liquidity is high, gold prices get supported. This happened immediately in the aftermath of subprime crisis. Between November 2008 to September 2011, gold prices nearly doubled from $750 to $1,900. This time, there is one more factor which can support gold prices. China has $3 trillion of FX reserves. In many cases, in many countries, cases are being filed against China for COVID-19 cost. What if one of the judge orders to confiscate China's assets in their country and utilize it for COVID-19 cost? It has never happened in international market before, but that fear could push China to shift part of its FX reserves from dollar, yen, euro security to gold. And if that happens, gold prices will get supported. So subject to import duty, one should remain overweight gold despite rally from $1,450 to almost $2,000.
Okay. Anybody else have any contrarian view? If you don't, Navneet, you have a contrarian view only if you have a contrarian view.
Not a contrarian view, but I think
just to save time. Just to save time.
I think it should be taken as a hedge in the portfolio because the gold doesn't earn anything. It is not an earning asset class, but it's a hedge in a world where the government debt to GDP is going to touch probably an all-time high, facilitated by cheap money printing by the central banks. And in case that leads to an inflation at some point in time, or if this crisis becomes quite deep and you are in a deflationary scenario, I think as a hedge against both the extreme scenario, it makes sense to have a small part in gold. But investors should be happy if that part of the portfolio is not performing well, because that's the scenario where rest of your portfolio would do well.
Okay. Another macro question who wants to take is this. What's your view on the interest rate scenario? We're talking about not global scenario in India. Interest rate scenario, how long do you see this low? Because at this point of time, we're the lowest policy rate. Yeah, Navneet?
Sorry, you mentioned globally or in India?
No, in Indian context.
So I think
basically the gentleman or the lady probably want to know the debt market outlook in that sense. But what's your interest rate take on interest rate scenario?
So surely, interest rates have come down. RBI has unleashed a monetary bazooka, which has led to a substantial decline in the interest rates, not only for the government bonds, but for the top-rated corporates also. The juiciest part of the, I would say, bond price is the bond price gains are behind us. But looking at the overall growth inflation dynamics, the demand supply dynamics, there is a potential for interest rates to go down a little bit, not on the policy front, but because the term premiums and credit spreads are still high, there is a potential to make some amount of money, but a large part of the gains are behind us. Globally, I have a different view. From a medium-term perspective, I think this is a contrarian view that globally, I think the 40-year-old bull market is coming to an end.
Okay. Bala, I wanted to add something.
Yeah, just one point which I want to add is first time ever in the country, the transmission of interest rates to the low-rank rated borrowers have improved significantly thanks to one masterstroke announcement coming from Reserve Bank of India. Just by introducing LTRO for 3 years has brought down the rates not just for 3 months or 6 months, for 3 years. As long as that kind of liquidity and such kind of proactive policies coming from Reserve Bank of India, they probably will not see significant drop in rates, same time significant rise also. can be avoided because the proactive policy framing is coming from Reserve Bank of India.
This is a question addressed to Naren. Do you believe that unemployment may weigh on savings, leading to risk aversion and fewer savings coming into equities?
No,
The impact of rising unemployment on equity market. Naren.
The sad aspect is, the savings today of the people is coming from the people who are comfortable financially. And there are, in India, I believe at this point of time, there are a lot of unemployment people who are actually taken moratorium on their loans, which will be part of all your banking roundtables you're going to be doing next week. And that will be the discussions you will be having for all the people there. But in India, what is happening is the savings is primarily coming from the comfortable people financially. And what you're saying is 100% correct, that there are a lot of people in the informal sector who have been hurt and their savings is not going up. But for them, the problem, the challenges are coming with the personal loans that they have taken, the credit card debts that they have taken. And I believe that that will be the topic of debate in some other roundtables that you will be doing.
Okay. One micro question. It's a very debatable issue. Is this? Who wants to take this? What's your view on AT1 bonds? You know the IS Bank story. Anybody wants to take this question, or you want to give it a pass? There is nothing that you have to answer.
I can take the question.
Naren or Prashant? Tell me. Yeah.
I can take the question. See, basically,
quick.
I can take it.
AT1 bonds. Yeah. Please.
Yeah. See, the way we looked at it is we took it that we knew that the risks of AT1 bonds are not low, but at the same time, we were very convinced that the extra return that we were getting, we looked at it as a credit instrument, and that is how we looked at it. And we looked at it from that angle, and we believe that we are big believers that we cannot operate only in the AAA space and debt, because the AAA space and debt today is giving you interest rates of 3, 4, and 5%, which is very difficult for an investor to feel comfortable on. So we are very comfortable with AT1 bonds. But we believe that we look at it in funds like credit funds. We look at it in funds like the hybrid funds, because these are all the products where we think it makes a very, very significant impact. Because in those cases, we knew that there are risks, and in those risks, we actually applied all the credit standards that we needed to do. So the only one which bombed, we were not part of, simply because we thought that there are risks in that particular case, and those risks we were not comfortable with. So people thought that it was a zero risk instrument. It was never a zero risk instrument.
Thanks, Naren. One question, I think it's not exactly correct, and Prashant, you want to answer and all. He said, why don't Indian mutual fund offer global equities? I think you do, some of you, right? Prashant, you want to answer?
No, I think some funds do offer.
Yes, that's what I'm saying.
And some funds do offer.
Okay. One micro question is this: if there's a clampdown, what could a clampdown on China imports mean for input prices of various industries, for example, auto ancillaries, and the impact on their stock prices? Anybody wants to take that?
Could you repeat that, please?
Yeah, Prashant. The clampdown on Chinese imports, what would be the impact on certain industries like auto and ancillaries, and subsequently, of course, on their stock prices?
So I think this is a question which is very hard to link to stock prices, because certainly, I mean, not just for India, but globally, if you see a large part of the manufacturing supply chain resides in China. And if you ban things abruptly overnight, that you don't have alternate sources either in your country or another country, yes, it will lead to supply disruptions. But I don't think it is fair to say that something like that is going to happen, because the policymakers also, I don't think they will do any such thing. In fact, this raises a very interesting issue rather. See, three things have happened. One, the manufacturing costs in China have been going up steadily over last several years, and therefore manufacturing was shifting out of China into other neighboring countries. That was point number one. COVID is linked. COVID led to supply disruptions in China, and therefore there is a key need amongst many multinationals to adopt a China plus one strategy. And post the border standoff between India and China, I think the Indian government is supporting manufacturing in India like they have never done before. And I think this will lead to a resurgence of manufacturing in India. And we can see whenever government moves behind industry in a certain area, I think global and local companies will set up factories here. And India has one big advantage over other Asian peers, and that is the presence of a massive local market. India has seldom leveraged its domestic demand in the sense that we are doing it now. And I do feel that this will have very positive implications for manufacturing in India in the years to come.
Thanks. We have many questions, but for the time's sake, we will not pick too many. Maybe one or two more. Again, Naren, you seem to be a hot favorite among the audience here. To question again, Naren, you have always said that the infrastructure segment hasn't performed for the past 10 years. Would you now change your mind? Do you see infrastructure segment start performing?
See, actually, the infrastructure equity fund is a fund which does not invest primarily in IT and pharma. We are big believers that dollar will actually depreciate over a 10-year period against all other global currencies. We are not so sure against rupee, but against other global currencies. So we think within the equity space, we actually think infrastructure as a category can do much better than what it did in the last 12 years, primarily because the dollar does not have as good an outlook as what it had from 2008 to 2020. That's how we look at it.
Okay,
but
I will ask. Sorry, yeah. Please go ahead.
No. So the core infrastructure sectors like capital goods, it looks still that there will be time to deliver, but our infrastructure equity funds are much more diversified and they don't invest only in capital goods sector. So that's why you are much better off.
Okay, I'll ask this question to Nilesh because you also represent the industry body, being the chairman there. What would you tell investors who are contemplating buying shares of listed AMCs? Is it better to invest in the parent company than the AMC?
Well, I can't give any stock specific recommendation.
No, generally AMC they're talking about. Generally as a AMC as a class, they're saying, let's not get into all the stock. We are not asking for any stock. So I thought it's an interesting question. Do you recommend to buy the AMC or the parent company?
At a price, everything is a buy. If AMC company is cheaper, then please buy AMC. If sponsor institution is cheaper, please buy sponsor institution. But best thing will be to buy sponsor institution as well as the AMC where it is available.
You're always so diplomatic. You're just saying you buy both. Oh my God.
One USP of, just the other one thing, one USP of asset management business is that it has one of the highest return on equity in financial services industry. No bank, no insurance companies can ever imagine to achieve return on equity, which AMCs are delivering on a regular basis. So our valuation will always be higher compared to other financial services companies.
Okay, there are two more questions we will take, nothing else, and then we'll wind up because already exceeded 7-8 minutes. Whoever wants to there, I mean, I'm sure you will not agree with that, but one gentleman, it's a question in the form of a suggestion. Should again, I think Nilesh, you have to answer because you represent the industry body. Should all the mutual funds come together and they form a kind of a fund on the line of DICGC, the deposit guarantee scheme, for the investors to make good their losses? I mean, equity investment, there is a risk attached to it, so I don't think it is, but still, what is your take on that?
So one, Tamanna, if investors are losing money, certainly we can think about it. But show me one investor who in the debt funds have lost money. if they remain invested for the time horizon which they have come in. I can talk about my credit risk fund. We have credit events, we have seen spread expansion, but on a 3-year basis, my credit risk fund has never delivered negative return. It is always positive. No one has lost money. And this is true for majority of debt funds. If I look at on a 3-year basis, debt funds have delivered return between 7% to 9.5%. Where is the question of people losing money? If you come on a 1st April and on 26th of April, you do a mark to market, yes, there is a loss. But please remain invested for next 3 years and you will see you are making money.
Okay, the last question from the audience, and then we'll have a 30-second one answer from each of you. I'll seek to my question. The last question is this: are you expecting big kind of PSU, divestment this year? Whatever the rest of the year is left, which is we're not even crossed halfway mark for the current financial year. So, do you think there'll be a big PSU divestment issues, including LIC? Etc. It's the investors want to know. I think they will keep their money now for that kind of IPO. Navneet, you want to answer? Are you first?
So
they
post the global financial crisis, the bull market actually started in March 2009. If you see the Bfsi 100 index from that point has gone up 4x. And a good part of Bfsi 100 index included PSU stocks. But if you look at the PSU index, Bfsi PSU index is flat for 11 years. They've substantially underperformed. I think if government is able to achieve one divestment or make some other efforts to get the re-rating of the overall sector, there is a lot of potential in some of these companies in terms of the intrinsic value that some of these assets have.
Okay, anybody else could? Bala, you want to add something? Do you think the LIC IPO could be the game changer?
Any of these strategic divestment, that IPO, not doing the ETF, continuous selling, and maybe some bit of effort, there is a possibility of a significant re-rating compared to where they are today relative to the rest of the market.
Okay, Bala, you wanted to add?
Yeah. No, just to add to what Navneet is mentioning is, I think public sector companies are deeply valued. There's absolutely no doubt, given the fact the segment in which they operate, and therefore holds huge potential. So the divestment of BPCL, one will set the ball rolling, and how the value is getting unlocked by bringing in foreign partner and create value for the future. I think LIC divestment and the way the private sector insurance today are getting evaluations, and LIC, what was known is a dominant player in the financial market. And LIC, I think if we plan it nicely, it can become a similar kind of trend that we have seen in globally. The way I think Saudi Arabia is looking at listing Aramco, I think LIC can create a similar kind of headline for India, given the fact that they are the market leader in the country in the insurance business. What was written, nobody can beat actually LIC when it comes to the question of insurance, such as strong household brand. Naturally, the government, of course, has to put a little extra effort and ensure that is marketed properly and they get the right valuation for that, which in my view, the way I think it's being done, probability of both the things happening, both in the case of BPCL divestment and LIC divestment, is quite high with reasonably good fanfare.
So Bala, just to add one thing, so you don't think you will go the Coal India way? Because what you said, Aramco there, what we did for Coal India at that point of time, there's the largest issue, so much of noise, and people say to change everything as far as the PSU sector is concerned. But where is the Coal India?
One fundamental difference, Tamal, between coal and LIC. LIC is going to have a perpetual growth, but for the competition that is coming from the private sectors, it continue to have a perpetual growth given the fact that they operate in different segments.
Okay.
Whereas Coal India is actually something different given the fact that environmental issues and moving away from the coal-based producing of power actually to the completely different kind of power segment. So all such things actually dynamics comes in the way of coal, but a similar thing is not there with respect to LIC.
Thank you. Thanks, Prashant, Naren, Nilesh, Navneet, Sandeep, and Bala. Thank you for your time. I think we had a pretty interesting discussion. As a moderator, I wanted to figure out whether I can not exactly play one against another, but we can have difference of opinion. But I think you are unanimous in your, I don't know whether you discussed it among yourself before coming here. None of you is saying that market is ahead of economy. You are justifying the market move. You are saying market is factoring in the potential of Indian economy. That's what you said. I think that's the key takeaway. You are saying, of course, that's not new, that stay invested, have patience, because that's the nature of the beast SIP. You don't expect it in 2 years or 3 years. But the basic difference, what the public perception, and including Reserve Bank of India, today, country's chief money manager, what he said, and you manage also people's money. The difference is this, unlike others, you do agree it's a liquidity-driven rally. You do agree that there is nothing much happening at this point of time in materially, but you are saying that you have the potential to grow and there is nothing to be worried about, and the market has factored in. So 30 seconds each from each of you, and you can be diplomatic, you don't have to say, but my job is to ask you is this. All of you said that this, nothing, no looking back, you don't see any crash, etc. So where do you see, I'm not talking about 5 years, 10 years kind of thing. Do you, by say March in this year end, where do you see the index level? And which are the sectors, big no and big yes? Don't have to stocks. And we are not for any stock recommendations, but for investors, for their knowledge, which are the sector they should watch out for being cautious, and which are the sector they should actually welcome in their portfolio. Starting with Prashant. That's the last round, 2 parts. Your idea of what is your take on the level of Indian market by March 2021, that's the year end. As we have discussed, is the second highest best performing market since the March low after Russia, more than 50%, both in rupee term and dollar term. So why do you see indices in the end of the year, if you wish to say, and a few sectors which is big no should not be touched, and if you few sector you think people should get excited about? Prashant.
Yeah, I am positive on the markets. That's point number one, though it is extremely hard, and I don't think it is appropriate to put a time-wise target to the markets, because fundamentally we believe it is extremely hard to forecast equities. Only point is, look at last 10 years. India has done nothing. When you say India is best performing, except Russia, it is from our point of time. And that is preceding a very big fall. But if you look at last 10 years, we have done nothing. So I would give more weightage to the 10-year underperformance of the market than to this bounce. Coming to markets, I find basically the consumption-oriented companies, and I've been wrong on this for a while, but I do feel that the consumption-oriented companies are extremely expensive. And I think if there is one lasting impact of the current environment, it is on the incomes of the low to mid-income people. And therefore, I would avoid that. But other than that, I find markets to be either fairly valued or undervalued. And I think, to my judgment, the utility space in India is offering value like the way it has never offered before, but it has not done well for a considerable period of time.
Thanks, Bala.
Yeah,
Bala?
I think, yeah. Well, I see, I think you're talking about March end. I think I expect the market to reach a new high, given the fact that we'll be come out of lockdown and the real impact of that getting reflected on 2021 earnings expectations. I think that brings in some kind of optimism. Therefore, I expect the market to touch a new high, which is about 12,000 index. With respect to sectors, clearly the COVID has changed the whole industry dynamics for not just for 1 year, even beyond 1 year, especially in sectors like pharma and IT. Even the banking financial service sectors have taken a huge beating in this period of time. There is high probability as the economic recovery comes back, since they are the proxy to the economy at any point of time, they will also tend to perform well with the market.
Thanks. Navneet?
So I think, Tamal Dada, if you had a crystal ball exactly a year back and had told me that there would be a massive virus, there would be a health crisis, lakhs of people will die, India will have a rating downgrade, we will have the worst recession in history, but inflation will be close to 7%, we will have a conflict with China, we will have a rating, I can go on. Where would the market be? One would have said maybe 20-30% lower. The fact is we are actually higher than where we were a year earlier. It's very difficult to predict the market over a 6 or 9 month period. There are so many variables at play. Having said that, I agree with Prashant that last 10 years, equities have not delivered as an asset class. Going by the history of last 30-40 years, the next 10 years are likely to be good, but I think it's going to be highly volatile in next 6 or month for all the reasons that we would have discussed in last 90 minutes. The Robinhood effect, the central bank liquidity, so much of uncertainty on this health and economic crisis. So one should be prepared for a much higher volatility, but maybe next 10 years it should do well. On the sectors, I would just say focus on bottom up. There are parts of the market which have become now probably more richly valued. There are still parts of market, some of them Prashant alluded to, are offering good value.
Sandeep?
You're mute,
Sandeep.
Mute.
Sorry. I think the way we see COVID has changed a lot. And I think this conference that we are having today, I mean, normally every year we used to have about 400-500 people. Today, it's about 10-20 times more number of people watching this. So I think the new trends to watch out is how the companies are going to be responding to these changes. For us, I think we believe the winners of tomorrow could be very different compared to the earlier years. Two things the themes which remain very critical for us is the execution capability, companies which do not carry debt, and high quality management. So these are the three themes that we are looking out future.
Naren?
I think we are in a developed world central bank bull market. We have to remember that every day. And therefore, we should remember that there is a US election coming in November that we should remember. Having said that, I think I agree with Prashant. Utilities is extremely cheap at this point of time. Value, dividend yield, focus value, special situation. These are all areas which look cheap. All the quality areas like consumer staples have been costly for a while and they continue to be costly. And I believe that one has to be, at this point of time, you have to recognize that, interest rates are low thanks to global central banks putting in so much liquidity. And we have to keep watching the world because we have never seen such a global central bank induced liquidity that we have ever seen. And that is something we are going to learn over a period of time, how to handle global central banks who have started to dominate stock markets on a scale that we have never understood after 2008.
Thanks, Naren. So Nilesh, you have the last word. And can you also touch upon, do we see a sort of shift from value investing to growth investing? Globally, what you're saying in US and India, I'm not getting to name of the stocks, but do you also see a shift in this thing? Very brief, 30-second or maybe a minute. That's the last one.
Dada, I think already shift has happened in terms of flow from value to growth. Value has underperformed the market for probably more than a decade. Going forward, events will determine where markets will be. If events flow out better than expected by the market will be higher in March 21 and vice versa. More importantly, as Navneet Bhai mentioned, it is time to be far more bottom-up rather than top-down. In banking and financial services, you can get one HDFC bank or you can get Yes Bank. So it's extremely important to pick up right management, pick up good companies where management is working hard, where minority shareholders' interests are protected, where they are less leveraged, as Sandeep Bhai mentioned. And more importantly, they are innovative in cutting costs and adopting to the COVID-19 era. The heroes of post-COVID-19 era will be determined based on how they have behaved in this COVID-19 period.
So thank you, Bala, Sandeep, Navneet, Nilesh, Naren, and Prashant. I think we have a very informed discussion for the past 95, 100 odd minutes. I don't want to repeat and get on your nerves. It's pretty interesting. I wish we could even go on longer. So thank you, and thank you, the audience. This is the fourth in the series of Business Standard BFSI Unlock 2. Next week, you will have one day on 26th is insurance, both life insurance and general insurance what are your expectations during COVID time, how the insurance players are doing differently. And finally, on 27th, timing is different there. It starts at 10:30. Reserve Bank of India Governor Mr. Das will kick off the day with his keynote address. Then we'll have an interaction, a fireside chat. I don't know whether I can call it fireside chat on web with the governor. Then we have, of course, India's biggest bank CEOs of India's biggest bank discussing the current economic and banking scenario. So thank you all. Thank you for watching. All of you stay safe and very good evening, good night or good morning, depending on whatever geography you are in. Thank you.
Thank you, Tamal.
Thank you.
Thank you.
And thanks to all our panelists for the insights. Thank you, SBI Mutual Fund, our partner today. And thanks to the audience for joining us. As Tamal said, 2 very busy days coming up in the Unlock BFSI 2.2 series. The insurance panels are on 26th August. Please note we will begin at 4 o'clock, not 5, which was the time for the discussion so far. So we begin at 4 o'clock and there are separate discussions on general and life insurance. The next day in the morning, we have the banking discussions. 10:30. We hope to see you all there. That's goodbye from us. Have a great weekend and see you again. Thank you.
Thank you. Thank you.
Thank you.
He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard.